Today, we're diving into one of the most important conversations investors can be having right now. The future of the US dollar, the rising demand for real assets like gold and Bitcoin, and what you should be doing to stay ahead. Right now, major cracks are forming in the foundation of the global financial system. Goldman Sachs, one of the biggest names on Wall Street, is warning that the US dollar could fall by 25 to 30% based on historic parallels. At the same time, the IMF, the International Monetary Fund, is forecasting a sharp slowdown in U.S. economic growth for 2025. And the cracks don't stop there. Foreign demand for U.S. assets, a key pillar that's kept the dollar strong for decades, is starting to weaken. When that foreign demand dries up, so does one of the main reasons the dollar has remained the world's reserve currency. Meanwhile, gold just hit a new record high of $3,500 an ounce. It's pulled back slightly, but J.P. Morgan now forecasts $4,000 gold within the next 12 months. Think about that. Major institutions, not fringe analysts, are now calling for gold to surge another 15 to 20% from already record levels. Even Treasury Secretary Scott Bessent is sounding alarms, calling for a reset of the global financial system. He's urging the IMF and World Bank to stop focusing on social issues and instead return to their original mission, promoting economic stability. To break all this down, we spoke to Frank Holmes, CEO of U.S. Global Investors and Executive Chairman of Hive Digital Technologies. Frank has been ahead of these trends, and today, his insights are more important than ever. Frank believes we are still early in a secular bull market for decentralized assets like gold and Bitcoin. In fact, based on global money supply growth across the G20 nations, he believes gold could easily reach $6,000 an ounce during President Trump's next term. That's not a hope, that's math. Now many people are asking, if gold's going to $6,000, why hasn't it already exploded higher? Frank's answer, gold's rise has actually been slow and steady compared to the size of monetary stimulus and money printing we've seen worldwide. He points to M2 money supply growth, not just in the US but across the largest economies globally. When you expand money supply at this pace without comparable economic growth, something has to give. And historically, gold has been the asset that catches up and then surpasses in value. Frank made a fascinating analogy. He said that when you see government policies shift dramatically, it's like tectonic plates shifting under the economy. The result isn't always immediate chaos, but it sets the stage for massive changes over time. One of those shifts? Tariffs. Under President Trump's strategy, tariffs have risen sharply, especially against China. Frank explains that when tariffs go up 25%, it's logical to expect the dollar to decline by about the same margin eventually. It's basic supply and demand economics. Higher tariffs mean higher costs for consumers and businesses, which in turn puts pressure on the currency. Now this isn't just about trade policy. Frank warns that the real battle is geopolitical. China is not just competing on trade. They're actively challenging U.S. influence around the world. Frank pointed to cyber attacks against American infrastructure, military expansion into the Arctic, and efforts to encourage countries to move away from the U.S. But despite these threats, the dollar remains resilient, for now. Global trade still heavily relies on the greenback. But the warning signs are there for anyone paying attention. Meanwhile, back in the real economy, Frank said he just visited New York and Toronto recently. Every restaurant, packed, every theater, sold out, every flight, full. The doom and gloom recession headlines don't match what he's seeing on the ground. However, beneath that strength, the financial system is quietly repositioning itself, and the smart money is preparing. Let's talk about that preparation. First and foremost, gold. Frank stresses that we are still in the early innings of gold's next major bull run. Institutional participation is still low. Most pension funds, endowments, and major asset managers barely hold gold relative to their total portfolios. ETF ownership of gold stocks remains at historical lows. This means two things. There's plenty of room for new money to enter, and when it does, the moves could be explosive. Frank also highlights how central banks, not just in emerging markets but in developed countries, are buying gold at the fastest pace in decades. Why? Because gold remains the ultimate store of value when trust in paper currencies fades. Now, let's pivot to Bitcoin. Bitcoin is a completely different animal, but it's thriving too, for different reasons. Frank told us about Blockchain Week in Paris and how the turnout was massive. Over 9,500 people. Tickets costing over $1,000 each, and selling out. This isn't speculation anymore, it's infrastructure being built. New companies, new payment systems, decentralized apps, a whole new financial ecosystem is rising alongside traditional finance. Frank explains that Bitcoin adoption follows a simple law of networks, Metcalfe's law. As more people adopt a fixed supply network like Bitcoin, the value grows exponentially. And Bitcoin's supply is capped, 21 million coins, period. Roughly 19.5 million have already been mined, and estimates suggest at least 3 million are permanently lost. This scarcity, combined with growing demand, creates the potential for rapid price acceleration. Frank believes that once Bitcoin clears $97,000 convincingly, it could surge to $120,000, then $150,000, and longer term, even $400,000 is not off the table. Now you might be asking, but doesn't Bitcoin compete with gold? Frank says no, it runs parallel. Gold and Bitcoin both serve as decentralized alternatives to traditional fiat currencies, but they serve slightly different roles. Gold is tangible, trusted, and time-tested. Bitcoin is digital, fast, and portable. So what is Frank's advice? Own both. He recommends a 10% allocation to gold and a 5% allocation to Bitcoin or Bitcoin miners in a well-diversified portfolio. Now let's step back and think about the bigger picture. Today, the dollar is under pressure. Geopolitical risks are rising. Central banks are buying gold. Younger generations are adopting Bitcoin. Smart investors are not waiting for headlines to tell them what to do. They are positioning now. How diversified are you today? Are you holding real assets that can weather inflation, currency devaluation, and geopolitical shocks? Let me know in the comments below. I'd love to hear your thoughts. One last thing before we wrap up, Frank pointed out another major trend. Wall Street is starting to move in. We're seeing $3.6 billion SPACs deals focused on Bitcoin accumulation. We're seeing state governments looking at Bitcoin allocations for pension funds. And Tether, the stablecoin giant, is acting like a global shadow bank, holding massive reserves of gold, US bonds, and Bitcoin. In short, the shift is happening faster than most people realize. Frank's big takeaway? Stay diversified, own real decentralized assets, gold for stability, Bitcoin for growth, and don't wait for a full-blown crisis to start preparing. If you found this breakdown valuable, please hit that like button. Comment below. Are you allocating more to gold, Bitcoin, or both heading into 2025? And don't forget to subscribe to Gold Nest Investments for real-time, trusted updates on the markets, precious metals, and smart investing strategies. Stay informed, stay prepared, and we'll see you